We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is CEO and founder of Quill Intelligence and former Fed insider, Danielle DiMartino Booth. How are you today, Danielle?
I'm doing great. Thanks so much for having me today.
Great to have you back. So something we've touched on before on the show is the rate at which bond yields have moved up. And as we saw that recently, I'd like to get your explanation as to why this is such an important aspect of yields to be looking at.
So we're a very indebted country on every level, whether it's households, even though we're not nearly as indebted in the United States as we were, say, in 2005, 2006. There are other countries that you could point to, Canada, Norway, Australia, where the household debt to income is much, much higher. Nonetheless, American households have a lot of leverage. American corporations have more leverage than they've ever had. And clearly, our national debt's pushing $30 trillion. So if you look at the world through the prism solely of servicing that debt, well, that's fine, as long as your interest rates, the yields on bonds are very, very low. If they start to rise in an overly indebted world, then the wheels start to fall off one by one. And that's why it's so critical. And that's the reason we've been able to see this massive debt run up in recent years, is because the Fed has been able to orchestrate keeping bond yields near the zero bound for an extraordinarily long period of time.
So as a former Fed insider, how difficult is this moment to manage when we take into consideration how many different sources of inflation we're seeing at this moment?
So this is not going to be easy for Jay Powell. This is not going to be a repeat of 2011. 2011, we can't even imagine the consumer price index, the headline printed at 3%. I mean, right now that would be like, oh my gosh, the sky is falling. We can't imagine getting past that 2%, but yet we have, because of base effects, because in May of 2020, the year over year CPI headline printed at 0.1% year over year. So you don't need a big number at all to have a larger number than what the Fed's official 2% target is. In addition to that, we have a supply chain disruption that is a continuation of one that began with the trade war years ago. It was exacerbated by a pandemic, but it was not catalyzed by a pandemic. So you've got to work that through the system. And we've also had a major, major increase in shipping and freight rates in many ways, because so many countries have opened and reclosed and there aren't enough containers out there. And then you get the kerfuffle in the Suez Canal. And then we're throwing all of the money in the world at U.S. households. We've never, not in post-war U.S. history, have we ever pumped, I think Cornerstone Macro put it at $20.3 trillion of combined fiscal and monetary stimulus into the economy for non-productive means. This is just pure liquidity, go out and spend it. And many people have. So we've seen home prices completely go off the rails. We're seeing car prices higher than they've ever been. And then we saw a big, huge spike in revolving credit in the month of February. That was because on February the 3rd, most Americans found out that they were getting their stimmy checks, and they went out and literally charged spring break on the credit card. And so, because they knew they were going to be able to pay for it when they got the money in March, which they did. So whether you're talking about Disney or leisure travel domestically, hotels, leisure, again, Airbnb, the prices of these things are all going up at the same time. But supply chain disruptions will be alleviated. There is no trade war on the other side of this. That aspect is cooling. We are going to see shipping container rates top out and start to roll over. We're starting to see evidence of that. We're starting to see evidence of demand in China, whether you're talking about iron ore or copper. You're starting to see some of the heat come off of these industrial metals prices that have been seeing this huge run up, and there's no more stimmy checks for the United States. So we don't know that we haven't seen the last big jolt of spending. So it's going to get very uncomfortable for Jay Powell, but he says he can see through it. And that typically is the case, unless you were to find a means by which he could deliver money directly to the people. That's different. That would be inflationary over a very long-term timeline.
So as you were saying, this basically this year over year comparison of our inflation rate of last May over this May, is that also going to contribute to quote unquote inflation coming down as we creep up, further through June and July?
Yes, once we get past these massive base effects, we'll see the flip side of that. In fact, you ask a very intriguing question. When we get the next big jobs Friday, to take but one example, last April, and we're in the middle of what was last year was absolute Armageddon when the country shut down completely. Last April, what we saw was this mass layoff of workers in leisure, hospitality, restaurant, bars, low-paying industries. Millions of them fell out of the workforce. And that means that a year ago, that the average hourly earnings were skewed extremely high because you had only kind of high-paid people who could work from home left in the workforce. If we don't see an 0.4, 0.5% average hourly earning print in April, we're going to see year-over-year print turn negative. So base effects work both ways. And I think people need to have a greater appreciation for the fact that it's not just upside we're going to be seeing in inflation, but also downside we're going to be seeing in wages. And that also is going to have its own effect on investors in terms of optics.
That's a very interesting point, Danielle. And something else I was thinking about, what are some of the key deflationary forces that could help offset inflation from accelerating above target here? Is wage growth like that one of those forces?
It absolutely is. And, you've seen some very quirky headlines. One was in the Daily Shot, which I totally recommend if you're a Wall Street Journal subscriber, get that email every day. But there was this quirky headline. It said McDonald's paying $50 to would-be employees just to show up for interviews. And hotels are able to secure lobby, people to work the front desk in the lobby, but they can't get housekeepers. They haven't been able to open pools because they can't get bartenders. So, between the industries that have been really affected by low-skilled employees staying out of the workforce because they're making so much money. A buddy of mine, Peter Bookvar, says that when you do the math, they're making between $17, $18 an hour right now to stay out of the workforce. So you're going to see major U.S. corporations on Capitol Hill lobbying their congressmen, their congresswomen, their senators saying on September the 6th, when these re-extended emergency unemployment benefits expire, let them go. We need our workers to come back. We're not going to pay $20 an hour to a housekeeper. It's not happening. You're actually seeing there are several Krogers out on the West Coast where the state of California wanted to give the workers a $4 per hour surcharge just for showing up because it was a service-based industry where they were going to be in front of people. Kroger Corporate said, you know what, it's been an underperforming store. In fact, several in the area have been underperforming. They closed the stores. So there are all kinds of unintended consequences to paying people too much to not work and or demanding too much of companies that aren't in business as a charitable function, but they're in business to make money. And you have to resolve that tension. Don't get me wrong. Don't push the CEOs make too much money button because they do. And I get that. And I get that labor deserves its fair share. But in a razor thin margin industry like supermarkets, if the math doesn't work, you're just going to close the store and then everybody gets hurt.
That's a really interesting unintended consequence, as you say, of this MMT policy that's been instituted. But we've had several guests on the show tell us that the official CPI rate can be quite misleading and that it doesn't measure true inflation. What is your feeling on this? And has this metric changed over time to accommodate a changing economy?
There's right and there's wrong. There are some systemic issues with CPI. Two of households' biggest line items in their budget, housing, healthcare. They are systematically underreported, whether you're talking about the PCE, the core PCE, which the Fed favors, or the CPI, core CPI. So that's been the case. That's been the case for a very long time. I'm going to defend the CPI for a minute and say that hedonic adjustments when it comes to certain products, certain goods are valid. When you buy a car today, when you go buy a luxury Hyundai line car today, they can stack up to a Mercedes. and it's gonna drive for the next 15 years. That car is a lot more car than it was 15 years ago. And the quality that you're getting, the bang for your buck that you're getting, should also be adjusted in your price gauges. But again, the inherent flaw that has never been addressed and corrected, even though as a former Fed insider, I can tell you it's been recognized, is that there is an underreporting of healthcare, underreporting of housing expenses, and zero reporting of asset price inflation in these metrics.
Interesting. So, Danielle, how are you positioning yourself to account for more inflation, if that's indeed what we get? What are some traditional inflation hedges that are on your radar?
Well, I'm not really positioning myself for long-term inflationary pressures unless they open the Federal Reserve Act and allow the government to deliver helicopter money to people, in which case, I'll be in a bunker, I'll be in a fetal position at that point, because then we'll have true inflation like we had in the 1970s. But I've not given up my gold position, nor do I plan on doing so. My municipal bonds have been flying every time there's any kind of a tax rates going up, and that's about every other day. They improve. And also I've been very actively involved, have been for years, in private equity. You have a form of PTSD light when you come walking out the doors of the Federal Reserve. You have a very hard time with the stock market because you know that it's basically a fabricated read. You know that the Fed is in control of the price discovery mechanism that controls the corporate bond market and the stock market. So it's very difficult to say, I'm just going to take a flyer if I'm not going to become a pure trader and I'm investing in getting in and out. I mean, I get the buy and hold because don't fight the Fed and everything like that. But at the end of the day, you were in the 99th percentile heading into the 1920s, heading in December 30th, 1920. The price to earnings ratio on the S&P was 4.9. Heading into this December, 1 century later to the day, the price to earnings ratio was 7 times that level. I mean, you just can't turn your eye the other way. Look, there could be the next boon for the stock market could well be the fact that it looks like there's $1 trillion in dry powder that companies are getting to deploy in share buybacks. So we could theoretically see another leg up here. CEOs and CFOs don't know what else to do with their money except for buy back their shares. That's what the Fed's taught them to do over the years, and it's their job to maximize shareholder value, by the way. So I'm not saying that the stock market's necessarily a bad place to be. I'm just saying that every single metric on planet Earth, you've got the price to earnings ratio at about 38 right now. It topped out at 44 in December of 2000. I mean, I don't know what more you want to say you're playing with fire, but there are ways to discover private equity directly investing in companies, which I've done, and those precious metals and having exposure to them, as well as I know I'm not 90 years old, but I love my munis.
Well, as a more of a mainstream analyst, we appreciate hearing that for sure on this show. But Danielle, from your perspective, what are the biggest, you brought up the fabricated market that the Fed has made here. What are the biggest risks for the general market right now? Is it leveraged hedge funds that can start a chain reaction? Is it possible that there's another housing crisis? Or could we simply see, as you mentioned earlier, a seizure of supply chains due to higher prices for raw products?
Yes. I mean, there are lots of risks. Look, we saw Melvin Capital, and then we saw Archegos, or I really don't, it's only pronounced 5 different ways in the media, so who knows? But we saw another fund blow up in Sweden. And so we've seen what's happened with the SPACs. And we've seen what happens when there's even a rumor over the weekend that the US Treasury might be looking at Bitcoin, and then there's a ripple effect. So it takes any little thing to set off a chain of events. What bothers me the most, though, is that we've seen so many in a row. And normally normally where there is smoke, there's fire. I mean, there's a reason that cliches that make your eyes roll into the back of your head exist. And that's because they're tried and true. They're truisms. But we've seen quite a bit of smoke of late. And that makes you stop and wonder if one massive family if one massive family office can hide this much leverage. We know that leverage in the system at hedge funds is the highest it's ever been on record. But if there's ways to hide other forms of leverage that aren't identified until it's a past tense moment, and you hear, you're lucky to turn on Bloomberg on a Sunday and they're like, looks like Goldman Sachs and Morgan Stanley have gotten out of their positions. Credit Suisse, however, is toast. I mean, you're like, whoa, where'd that come from? If it's an after the fact thing, you know that there are other similar instances that are out there in the environment that you cannot prepare for as an investor because they're invisible. That's why they call it systemic risk.
So was there ever a way to that we would have been able to avoid this path that we're on and normalize monetary policy, Danielle?
So the reaction to the great financial crisis, as in let's pick up the over-indebtedness on the household balance sheet and move it onto corporate America's balance sheet. Let's just solve an over-indebtedness problem by adding more debt onto the problem. That was probably not the right route to take. COVID, however, presented the Federal Reserve with an extraordinary opportunity to find a release valve. They could have let the 54% of the investment grade bond market that is the lowest rated rung, that triple B rung that used to be 27% a matter of years ago, and now it's 54% double. They could have allowed the excuse of COVID to come riding in with QE. So you're pumping generic money, you're pumping generic liquidity into the system, but instead they chose to bail out the corporate bond market in name. And that was truly opportunity lost. I said it a few days ago. When Jay Powell looks back on his legacy, this will have been the moment that he missed. The moment that he was able to say, you know what? We had zombies in 2008 and 2009 that stayed with us. And instead of getting rid of them and getting rid of over-indebted, bad players, poor business models, under the auspice of a global pandemic and letting them restructure, Ford wouldn't have gone away. It might have filed Chapter 11, but it would have restructured and come back out. Instead, he grandfathered in any and all triple B bonds that were downgraded after March the 22nd, 2020. So he put a Band-Aid on it, which pushed us from 14% of US firms being zombies to 20%. So now we have a further drag on long-term productivity that could have actually been addressed. It would have been the first normalization step that the Fed could have taken in a generation. And it was thwarted at the time, and it's a shame.
And if there's one thing we've seen over the past year, it's how strange everything has become. Even if you look at, let's say, America's top 0.001%, they've made a lot of money over the past year. So how has this monetary policy widened wealth inequality in the US? And are there any ways to make any progress on that front, or are we on a one-way path in that respect?
Well, it's not that we're on a one-way path. It's that monetary policy in and of itself widens the inequality divide. There is no tool that the Federal Reserve has to try and get money to areas of the economy that would lessen the divide. They're not able to, the Federal Reserve is not able to come in and encourage STEM studies for all children in America. The Federal Reserve is not able to come in and say, instead of infrastructure in hyper quotes, in air quotes, we're actually going to do true infrastructure spending and put people to work. And so their tools are not applicable to what needs to be done to narrow the inequality divide. However, their tools also at the same time only go in one direction, widening it further. So it really is, it's not even a catch-22. It's a damned if you do and damned if you do as well. So, and they won't own up to it. And that's the most frustrating aspect, is that they truly will not admit to the fact that their policies only trickle up to the top 0.01%.
So Danielle, what comes next? As the Fed has talked about creating a central bank digital currency, from your perspective, what would be the pros and cons to adopting a system like this in the form of a US dollar digital currency?
Well, the reason that it makes so much sense implicitly in a country like China is because they make the rules, and it's a communist regime. So they don't, there is no Jamie Dimon I mean, there might have been a Jack Ma, but there is no Jamie Dimon saying, wait a minute, if you roll out central bank digital currency, you're going to plunge a dagger into the heart of depository institutions in America because people are going to want to have their accounts directly at the Federal Reserve. They won't have reason on a practical level to have a JP Morgan Chase or a Citi or a Wells or a Bank of America checking account if they can have it directly with Uncle Sam. And so on a practical level, we have to ask ourselves, well, how much value does our banking system provide to the economy the way that it's run? On a bigger level, if all countries, I saw a headline that Norway's headed in this direction as well. There are, I think, 90 central banks that are investigating central bank digital currencies. And a lot of it is a matter of, your best offense is a good defense of saying China can't be the only one doing this. We have to be sure that we're in the space. But by that same token, in a way, you're segueing towards a world when you don't necessarily have to transact in dollars. If everything is digitized, then there's not necessarily one platform that you're falling back on that's based on the SWIFT structure to move money around the world, if money can theoretically be more easily transacted in name the currency.
So would this not create a better, let's say, feedback mechanism for the Fed to be able to evaluate, let's say, how much money they're giving to their population? Would they be able to evaluate those policies on a much quicker timescale? Theoretically,
I suppose they would, but that wouldn't be the Federal Reserve. That would be some nationalized form of Big Brother. That's not the Federal Reserve's place. Federal Reserve's place is to maximize the buying power of the US dollar, not to spy on its citizens and control how much they get and how they spend it. Bear in mind, the way that China is looking at CBDCs and piloting it is that the money that's being provided to people electronically has an expiration date.
Interesting. So, Danielle, if the US, theoretically went down that road, could that mark the end of the dollar? And what effect do you think that would have on the rest of the world using dollars as well?
I think that there has been a slow move away from the dollar, and that's just plain in the data. It is still by far how most transactions are done. But yes, you would be laying the groundwork for the next generation of the financial system, one that did not revolve around the US dollar. And that is, in many ways, why the Federal Reserve and the US Treasury are so very reluctant to go down this path. And it's only when you read a headline that, the Biden administration is looking into this because it's a matter of national security, then you raise the discussion to a higher theoretical political level. But at a very practical level, that is why there is so much pushback on the part of the US Treasury and the Fed.
Interesting. Those are some great points there, Danielle. In doing some research for our discussion today, I came across a story about how you believe that Janet Yellen being at the Treasury is every bull's dream and every low-income earner's nightmare. So why is this?
Well, so Janet Yellen is going to, as she has said, she's going to go big. I quote her. And as long as you have somebody at the Treasury who's willing to say, we have all the tools that we need in the event of inflation. This is going to be a transitory inflationary moment. We will see through it. But for the moment, we're still in emergency mode. And as far as Janet Yellen's concerned, we're always going to be in emergency mode. So she's of the mind that because there are no consequences to endless money printing, that you can just keep printing money. Well, that money has to be de facto monetized, and that pours into Wall Street. But again, it's a transmission mechanism that is very blunt and only gets through to the wealthiest. And that is why the flip side, Janet Yellen could be Dr. Jekyll and Mr. Hyde in a sense, because if she gets frustrated enough to where she truly wants to try and get the money directly into the hands of individuals, and I remind people whenever I can, she's a UC Berkeley educated labor economist. That is her background. That is her education. So if it becomes her mission in life to get money directly to the people, because Janet Yellen, sadly enough, she's inadvertently helping Wall Street. She actually doesn't believe she is. Even don't get me wrong, she made tons of money from all those speeches that she made, but she really believes in trickle down economics. And that if companies are doing better, they're going to hire more people, even though there's zero empirical evidence to back that theory. But if she gets staunch enough and frustrated enough to say, I'm going to facilitate getting money to people directly, and that ignites true inflation, Wall Street better batten the doors, batten the hatches, because then she'll go from being, their BFF to public enemy number one.
So as you said earlier, Danielle, the thought of, let's say, helicopter money scares you quite a bit. And let's say Janet's goal of getting money directly to people is also probably a real negative. But wouldn't stimmy checks in this case be one and the same? How do you see that difference?
Well, stimmy checks are one and the same if you're speaking about stimmy checks in perpetuity. But right now, it looks as if, we can see the midterms. Sadly enough, I'm talking about politics, but we can see the midterms in front of us. And we know that because the legislation that has been passed has been purely down partisan lines. So in that's why we have checks and balances. That is how I answer your question, because there will be political blowback if there are two more bills that pass in fiscal year 2021, right? The US government's fiscal year ends September the 30th. But if there are two more stimulus packages of any kind, legislative packages of any kind, that are undertaken in calendar year 2021, and very fine point, the Senate parliamentarian recently agreed that could be the case. That would be the first time in US history that not two, but three bills were passed via reconciliation, which means you only need the 50 votes in the Senate. That will enter into the political discourse a level of divisiveness that is unlike anything we've seen in the past 4 years. And that's saying something.
Absolutely. So we're speaking here on the afternoon of the 22nd. And right before the call, you mentioned to me an interesting news story that you were talking about capital gains. Can you tell us more about what that is and why it matters so much?
So, it seems as if this administration needs to go and get some communication classes, because you can't have one tax headline after another continue to roll out. And, we know that corporate income taxes are probably going to be rising. Corporate taxes are probably going to be on the rise. And then you hear that, and Americans have, in recent history, they have this, $99.99. Well, that's not quite $100. At 39.6, that's not quite 40%. So Americans have this kind of mental ceiling, this psychological level of 39.6 is kind of being as bad as it could possibly get. And then you drop a bomb on the markets, and at 43.4%, people say, wait a minute, that's a bigger number than I was anticipating. And oh, by the way, you're talking, there's still wealth tax chatter that's out there. There's still corporate tax chatter that's out there. At some point, the occupants of the C-suite are going to throw up their hands and say, A, if I think that my taxes for my company are going to go up, I'm not hiring anytime soon. I'm going to wait and see how this falls out. So that could put the brakes on the economy. But B, I'm selling my personal holdings right now. I'm not going to pay all those taxes as an insider. And we've already seen insider selling go through the roof in recent weeks. So you don't want to have a cascading effect to where you have the quote unquote smart money rushing the exits, going, as long as I've got first mover advantage and I can get my profits off the table, I'm fine. Let the other people sit there and suffer. But if everybody tries to get to that exit at the same time, it never works.
That's a great point, Danielle. As we wrap up here, is there anything else that you'd like to leave our listeners with that is on your mind as of late?
We've covered a lot. We've covered a lot of ground. I will say that I did recently, my most recent weekly publication for Quill, I looked into the GI Bill originally when the veterans were coming home from World War II. And when you look at the New Deal and public-private partnerships, there are some seriously good things that we've done in US history that have produced gigantic economic returns. So I think, on a hopeful note, because people are always like, does she travel around with that black cloud above her head? On a hopeful note, We have some very, very promising precedents in U.S. history that could help propel the economy to the next generation of growth that I hope our politicians are wise enough to look back on and see as kind of an old mousetrap that gets us into a new paradigm.
That's a great point, Danielle. Thanks so much for your time today. Of course, for any of our listeners that want to read more from Danielle, you're available at DiMartino Booth on Twitter, and of course, quillintelligence.com. Danielle, thanks so much for your time.
Thank you. Appreciate it. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.